everyone get loaded up. Welcome, guys. Thank you for coming so long. We're just going to hold on a couple of more minutes just to let a few more people come on, and then we'll get going. We'll dive straight into it. But I recognize a couple of familiar faces and names, so thanks for coming along, guys. Appreciate having you here. Thanks for giving up your evening. A couple of more minutes now, and we'll get into it. Mark, you happy to get going?
Yeah, sure. Let's fire. There's no one waiting in the lobby, so yeah, let's might as well make a start.
Fab. Okay, thank you, guys. Thanks for those of you who have joined. Like I said, appreciate you giving up your evening. Time is one of the most the only finite resource that we have, and appreciate you giving up your time to spend this evening with us. We hopefully won't take up too much time. We're hoping that it'll take probably 30 to 40 minutes just to run through some content, and then we're going to give as much opportunity for you to ask any questions and get those answered for you. We don't want to leave anyone without any questions unanswered. So if you do have any questions as they come along, if you just pop them in the chat, or if you want to just keep them till later on, we'll have a Q&A session at the end. No silly questions, of course. So please do ask if anything comes along. If we don't answer them as you sort of ask them in the chat, then we'll answer them later on. So what is tonight about? Tonight is about kind of understanding what's going on in the budget and how that's going to affect property development going forward within the next sort of 12 months, further forward into sort of 12 to 24 months with the changes that are coming in, and just highlighting some of those and putting some plans together on how that affects your development strategy. So for those of you, some of you will know us, some of us won't know us. So a quick introduction. Mark and I are both directors of Prime Property Finance. I'll introduce Mark first. Mark is or has 17 years, or had rather, 17 years of experience as a business manager within HSBC, and then left to start his own commercial finance brokerage, which was UMO Finance, where he's financed deals, which more recently on Homes Under the Hammer. He's done large movie studios, lots of complex developments and everything in between, and has been more on a commercial, from a bit commercial mortgage background, business, banking, development finance, bridging finance. And then, he has a real close attention to detail when it comes to the nitty gritty of deals, and he tries to catch them early on so that, those potential discussions aren't causing issues later on in deals. And all of that comes from his experience. I'm Gareth Morgan. I've been an independent mortgage advisor for 16 years and a property investor for the last 10. I've carried out most types of property investing, from simple buy-to-lets up to HMOs, multi-unit blocks, large mixed-use schemes, and I've also done some commercial conversions, and obviously have helped a lot of clients do all of the others in between as well. So we are full-time property professionals, property finance professionals rather, and we speak on stage regularly at training events, forums, and we also have our own podcast, which is the Prime Property Finance Podcast, where we try and help educate not only our clients, but the wider community, property investing community as well. Trying to share our experience and knowledge and put it on webinars like this. So between us, we've funded over hundreds of different projects of all sizes, and we've built over the years great relationships with lenders. So hopefully that puts us in a good place to help you guys. And ultimately, we are speaking to developers every day, and we're learning from what they are doing, seeing the conversations that we're having with people on the ground within doing different deals in different parts of the country. So hopefully that's a bit of background about us and hopefully how we can help. And the aim of the game for us today is for you to leave with a bit of a better understanding as to what the finance market's going to look like and what the outlook for the economy is based on the budget and some of the changes coming in. So yeah, let's move it on. Mark, if you could just move it on, please. So the agenda for tonight is reviewing the budget. I'm just going to kind of pick apart the key things for developers out of that and what that's going to look like. We're going to have a review of the market and the wider UK economy. We're going to look at protecting and maximising GDV under the post-budget conditions. What are the changes coming in and how are they going to affect deals, either deals that you have in the pipeline or deals that your deals that you're currently doing at the moment. Deal structures lenders will actually approve in 2026 and what they'll need to see from you and how you can improve your chances. And also how to structure your finance and cash flow so that you don't run out of capital mid-project and still exit cleanly, even if the market shifts. So, and then following that up with some live Q&A. So, like I said, hopefully you'll walk away with some tips and hints on how to make your next deals better and how to protect your current projects from risks. Like I said, hopefully we'll wrap up in about 30 to 40 minutes, and then we'll have time for some questions afterwards. Next one, please, Mark. So I think Mark's going to give us a rundown of the budget and what the impact is on things at the moment. Thank you, Mark.
Yeah, fantastic. Cheers, guys. Thanks, Gareth. So as mentioned, my name's Mark. Got a large background in complex finance, specifically around development, refurb and commercial. So we just wanted to share, as I say, some of our thoughts following on from the budget which happened last week. Sorry, I'm just going to keep admitting people as we go as well. So reflections on what we saw last week, how we think that's going to manifest itself into the marketplace, and how that could potentially impact what you guys are going to be looking at, or some considerations you need to adopt in order to help yourselves navigate through what are clearly going to be some challenges in the marketplace. So our review of the budget is quite simple, really. There were no significant changes as such which directly impacted property developers. Now, there was, as you can see there was an increase in the tax that's going to be paid in terms of rental income. So landlords will see some pressure, additional pressure, in addition to the regulatory changes that have come about this year as well. So we can expect something to happen there that's likely to find its way into rents in the not too distant future. So invariably that will be passed on to the tenant, I suspect, in most cases. We are seeing an increase in dividend tax. Okay, but that affects all company owners, not just relating to property. I've put on here things such as increases to tax on alcohol and tobacco, which are actually above RPI, so RPI being the inflation figure, the retail price index. But most notably, I think, from it all was the freeze on income tax thresholds that we are going to have. So that has been extended by the Labour government as opposed to brought in new. So that was something they vowed they wouldn't necessarily do. However, they've just done that. So what you'll notice is the bits that we've pulled out here are not necessarily property specific. So you may be questioning really, well, actually, this has got nothing to do with property. And to some extent, you're right. However, what this actually means in terms of the budget is that there is going to be some fiscal pressure on households, and there is going to be less disposable income. Now, the net impact of that is ultimately going to be affordability. So if you are looking to build new homes or convert into residential units and so on, there is clearly going to be a downward pressure on what people can actually afford in terms of borrowing, mortgages, and so on and so forth. So the reason we bring these out, and these aren't actually, as I say, specific to property, they are going to have a negative impact on individuals. So we've seen some wage inflation over the past couple of years, which has been healthy and positive, but that's been largely offset by the increases in taxes that are being paid, the cost of goods. I'm sure we've all felt the inflationary pressures when it comes to doing your daily shopping and so on and so forth. So the message here is not necessarily doom and gloom, and we want to stay away from that because there's plenty of that out there in the news. We want to put more of a positive spin on it, but this is the reality of the situation that we're going to face going forward. There is going to be, as I say, this downward pressure on people's disposable income. And that invariably is going to have an impact on several factors. One, which will be what people can truly afford in terms of rents. So we're seeing rents going up, and Gareth will talk more around the market in due course. Whilst we believe there to be a ceiling, we know that demand is outstripping supply, and that continues in an upward trajectory, but there has to be a limit as to what people can genuinely afford. And the same is true with mortgages. So we have seen in the mortgage space some slackening or perceived loosening of some mortgage affordability criteria. But as I say, the net result of this is that we are going to see some downward pressure in there. So as I say, we don't need to dwell too much. I guess we can all look back at last week's budget, understand this is the second hike in taxes that we've experienced in 12 months. And you can blame whatever you want to blame, but it's the fact of the matter going forward, and we just need to understand what the impact of that is going to be on us. So that's a quick overview from myself as to where we think some of these pressures are going to come from. I'll hand back to Gareth now, who will just talk about how that then will manifest itself in terms of the market, where we've been and where we think we're going.
Yeah, thanks, Mark. And I think probably just a couple of the points from a budget perspective before we move on to the economy. I think the government's obviously, when they came in, they were talking about build, and they've still got a commitment to build 1.5 million homes in England in this parliament. And there's been major initiatives, which is a £39 billion in social and affordable homes programme and 16 billion in National Housing Bank. I think the big shift at the moment seems to be, especially under Labour, around the funds that are being poured into social housing and affordable homes, and we'll talk a little bit about that a little bit more later. And then to support that, one of the things that's being bandied about is a zero rate of VAT on social housing projects. So that's maybe something that developers will want to focus on a little bit more if you're not already in that area, and potentially talks of the mansion tax, which, whilst that's probably more of a political item, it probably won't even come in this in this parliament, and so that might not even be a shift. And the other one to make note of something that's already coming in, which is making tax digital. And that's definitely going to have an impact on all businesses, especially property businesses. And if you aren't aware of it, then you need to make yourself aware of it quite sharpish. But it is something that's going to impact things. And then probably the other nod of the budget from my side is the potential tourist tax, which will affect people who have got Airbnb, or if you're thinking about developing properties into Airbnb and holiday lets. That's just something to be mindful in the longer term planning of your cash flow forecasts and deal viability, really. But again, that's it's nothing set in stone on that, but that's something definitely to keep an eye on. So if we move on to sort of the economy and what that looks like. So there's two parts of this. Is one is the sort of impact on the sort of property market, and then just talk a little bit about the wider economy so that you can understand how that impacts the property market really. So this isn't designed to be an economics lesson by any stretch. I think it's just kind of giving you a little bit about the broader, high level metrics that we see and how that impacts things. So, firstly, in the residential market, we expect changes in house price growth. We know there's, as we just mentioned, there's a huge shortage of supply of housing. And so if you can produce housing, then there's going to be demand for it. The key sentiment is going to be what type of housing is it, and what is, making sure there's enough demand for that specific type of housing. So as an example, we talked a little bit about the mansion tax for homes over £2 million. This tax might come in. So if you're developing properties which are worth more than £2 million, is that going to impact it potentially? Then yes, it is. There's more and more money being provided into the social housing space. So is there going to be a stronger demand for that type of property? Then likely there will be. So it's just kind of seeing where these highlights are being spoken about in the budget and in the press, and kind of try and follow the money, as it were. Buyer sentiment. Buyer sentiment's going to be up. It's always going to be strong, like you said. We know there's a shortage of housing, but buyer sentiment will come down to affordability. Mark touched on it, and we'll touch on that again shortly. Regional variations. We always know we talk a lot about the north and south divide, but that will come down to costs. Ultimately, in some parts of the area, some parts of the country, we are seeing above average growth and demand. And so again, maybe if you're developing, if you're based in the south and you can't make deals work, then you may need to look in other parts of the country where deals do stack up a bit better. And then you have to go about, well, how do I get involved in that market, remotely or working with other people in that area? And then build to rent is possibly something, if you're not being focused on, if you are developing sites, you should at least have renting them out and refinancing as a backup plan, anyway, as an exit. But this is, definitely becoming a more viable exit now. So there's a lot more developers looking to build to rent straight off. Second part of that then, in terms of the market, and this for me is, we've talked about the inflationary pressures, but for me, this will be the biggest impact on your success or failure going forward in how you actually assess deals. Cost of labor, costs of materials, supply chain stability, and contractor availability. Obviously, depending on the size and project and the location, there is limited contractors, actually the ability of certain contractors to carry out certain types of projects, especially now, with the amount of admin, management that goes into various parts of it. We'll talk more about cash flow and drawdown later on, and how important it is managing that. So, having the right contractors, being able to not only deliver on site, but also deliver the paperwork that goes along with that is going to be crucial. And ultimately running a tight ship and delivering projects on time and on budget, which is absolutely crucial. But I think on budget is the one that might catch people out, because if you take a property through the development journey from finding a site and doing your initial deal assessment to agreeing the purchase, and then taking that through the planning journey before you start getting on site and building that out, that could be a 4-year project. Now, if you took back, and a number of developers, clients of ours and other people that we speak to have gone through this exercise, and some of the numbers are quite frightening, where they've gone back and looked at their project analysis from 4 years ago, they've reviewed that, and then they've plugged in today's figures to what it actually, if they were doing it today and running the project, and they're wildly out. You've gone from making £500,000 to losing £500,000. It's drastic, the changes. So really need to drill down into the numbers and make sure that you're getting actual up-to-date figures and how impact that in the deal or assess that in the deal analysis. And in the land market, the old adage is you make your money when you buy the property or the land. And so, again, another old adage is, and this, it still tickles me now, where a third, a third for the land, a third for the development, and a third profit. That's long gone out the window, and trying to get vendors to understand that is probably one of the biggest challenges in the market. Residual land values, are shifting, and it's just making deals work. And I think expectations will become a lot more clearer, and I think as there's more news on inflationary pressures and stalled sites and things like that, then vendors will become a bit more open to negotiations, and there may be more off-market opportunities coming onto the market as people feel the squeeze and want to free up some cash. Some of the non-budget related changes that are in the press and affect the industry. Obviously, the renters reform bill is coming in now. That's been approved, and that'll bring huge changes in English rentals. Obviously, in Wales and in Scotland, those changes have already happened, and ultimately have probably been a good thing. They've raised the standards of landlords and investors, professionalized the game. But what we're seeing is a shift from singular landlords who own one or two properties, and the gap is divided now, shifting more into professional landlords. And then obviously the changes in EPC legislation. So if you're now developing, being very aware of the EPC output of any new properties, whether that's conversion or new build, and what impact that's going to have, because buyers are becoming very green aware, for want of a better word. And so there's clear evidence out there that the higher the EPC, of the property, the more value you can get for it. Now you've got to run the difference in the value versus the cost of getting it to that point. And again, that's going to be part of your deal analysis is, for us to get a developer a block of 10 flats at a EPC, what is that going to get us? What is the additional cost going to cost us compared to what are we going to get additionally on the end values? It's all well and good saying that you're going to get more money for them, but how much is it going to cost you, and is it worth that additional spend? So again, those are some of the things to consider. And then just moving on to the sort of UK economy then, on a bit of a higher level view. The UK economy, I'm pretty sure everyone would agree, is in a bit of a difficult place at the moment. And I'll share some of the reasons why and just some highlights, and I'm sure everyone's got their own opinion on it. And this webinar certainly isn't political by any stretch. It's just what facts of where we are as an economy currently and what we kind of predict and see things going, or how we see things going in the next couple of years. Everyone knows the gap between the rich and poor is becoming wider and wider. And the wealthy people are leaving the country in droves. Everyone either knows someone who knows someone who knows someone who's moving to Dubai, I would imagine. And so all the wealthy people in the UK are now deciding to leave. And those are actually the biggest taxpayers. And so I'm not sure what the government's plans are, but to how to counter that. But that's something else I'll leave with you to ponder. Our high streets are tired. Town centres are dying. It looks tired. Whilst there are opportunity there's most town centres are struggling, and so that leaves a damp. It doesn't exactly look good from outside. 21% of working age people in the UK are not currently working, which is a huge number of people not employed. And this stat baffled me. Over 50% of the population now take out more tax revenue than they actually put into the system. So if you can imagine a business where more of your clients took money out of your business than they put into it, it's not a good place. So it's difficult to balance the books in that sense. And then overall productivity is down. So we're just not as productive a nation as we used to be. So what does all of that mean to investors and developers? Some of the key metrics we look at now and how that will impact the next 12 to 36 months. And this definitely isn't a scaremonger, because that's not the case. We're just trying to live a little bit in reality, because we don't want you to make mistakes and get into deals that don't make money, and don't take the shirt off your back ultimately. But we want you to be aware of the landscape and what lies ahead, so it allows you to make smarter decisions. So the first metric on the economy is GDP. So GDP in the UK at the moment is 0.2%, which is pretty much flat, and has been flatlining for some time. But the big stat over the last couple of years is that the UK, well, over the last 200 years, the UK has been one of the top 5 economies in the world. And now in the last 2 years, we've dropped outside the top 5, and that's unlikely to change. There's nothing really that jumps out to make us get back into the top 5, because we're not producing. Salaries and quality of living has reduced. Whilst people think of they're getting a pay rise, when they actually look at the nitty-gritty of it, disposable income has probably flatlined or gone down, and it's now lower. The UK disposable income is now lower than the 5 poorest states in the US, which is quite daunting. And then the key one that we've mentioned a couple of times already is affordability. This is a critical item for developers, on whether you're building to sell or whether you're building to rent. And whether you want to rent or you want to buy your own home. Ultimately, affordability is becoming tighter. Interest rates are going up. Over the last 10 years, we've had very low interest rate environment, which has been great. Great for us personally on our own residential mortgages, but also great for rental, because there's been good margins. But to buy a house in the UK at the moment, the average income you need is the average affordability is 4.5 times your income, and most people can't. Well, not most people. A lot of people can't afford that, and so they turn to renting. And an unusual metric that's used in a good economy is that total household costs should be 30% or less, and now rent alone is 32%. And that's not including gas, electric, internet, council tax, and all the other costs that goes with it. So the rent trap is getting worse. It's even harder now for people to save deposits to get out of that. And then the banker mum and dad are probably struggling a bit more than what they've used to be, because they are feeling the squeeze, and there's less deposits forthcoming and support forthcoming to those first-time buyers. And then we turn to the wealthier side of the market, and like we said already, many of the wealthiest people in the UK are leaving, and we are now number 1 in the world for the number of millionaires leaving their own country. So that's gone up. We're the leader in that. So again, that just gives you a bit of a state of affairs. And then also, the middle class being hammered now, because every home in the UK spends £4,000 per year on government interest alone. So just kind of giving you a bit of a setting the scene really of where we are. But it is good news, and it's not just doom and gloom. We're just trying to paint a picture for you. Property prices have increased 25% over the last 5 years, and rents have increased by 40% over the same period. And there is plenty of stock available in the market. So there's more properties available on the market at the moment than there has been for a while. So there are deals out there. There's deals to be done. So if you know what you're looking for and you're prepared and you're well educated, then there are deals out there. So if we look at some of the other key metrics, inflation, that's predicted to be brought under control a little further and brought down towards the 3% mark next year. And then if that happens, then hopefully we'll see a Bank of England interest rate around the 3.5%. And then generally mortgage rates will come down with that. This is basing mortgage rates on buy-to-let mortgage rates. The average fixed rate now on a 5-year fix is about 5%. So hopefully if rates do come down and inflation's under control next year, we may see that drop down to around 4.25 to 4.5%. And then kind of the last two is property prices. They've gone up, like I said, 25% over the last few years. That's probably flattened out a little bit over the last couple of months where there's been people probably sat on their hands and not doing deals because of the budget. But there's plenty of liquidity in the market. Demand and affordability restrictions. There's plenty of demand, as we mentioned. And then also quite a key one, we touched on affordability. But some restrictions have been removed by the government, which were put in after the last economic meltdown in 2007, 2008. So that will allow prices to rise a little bit, but also let that be a little bit of a warning as to what that could lead to as people overstretching themselves and not being able to keep up with some of those finances. And then finally, rents. Rents will start to hit the ceiling. Like we said, 40% rise over the last few years. What we've started, we've spoken to quite a few valuers recently. We've also mentioned some clients have mentioned that whilst a rental figure that you could get, there was one example this week where when they did a deal sort of 6 to 12 months ago, they anticipated getting £1,500 a month in rent on a property, and there was only sort of 2 properties available. Now there's 10, 15 properties in same type of property in the area, and they're going for £1,200 a month. So there's quite a big shift happening in quite a short period, and that's just some of the. So if you push in for your top rents, just be mindful that people are probably stretching themselves, and then you may be opening yourself up to some rent arrears, and that could cause you some problems further down the line. So that's a bit of a wrap up of the economy and the market. Hopefully that's been a little bit useful for you to kind of start planning your own developments and projects for the year ahead. Mark?
Yeah, thank you. Thanks for that, Gareth. So as you can see, I mean, it doesn't make for great reading or great listening in terms of where we're at, and I think we can all accept that, you know, since COVID in particular, that we're obviously feeling some of the tailwinds of a lot of decisions that were made during that period, quantitative easing and so on and so forth. So, yeah, naturally there is going to be some sort of constriction in the marketplace, and we're now in that place. So, that being said, what does that actually mean for us and you guys as developing as properties? So, what we wanted to take a look at, and I guess some of the reasons why you guys are here, is understanding what we believe to be some of the ways in which you can sort of protect yourself from what's going on. Some of these things are unfortunately outside of your control. So hence us spending a bit of time talking around the economy and these sorts of things. There's only so much you can do as individuals. However, as I say, once you understand the environment that you're operating in, then you can put the mitigants in place to try and help yourselves get the most out of the opportunities that are invariably there. And we're doing many, many deals with clients as we speak. So it isn't all as negative as it may at first look. So this section then we wanted to talk about protecting and maximising GDV under the post-budget conditions. Now, maximising your GDV is one thing, and we spoke about, you know, not trying to push the boundaries and that sort of thing as well. So we actually wanted to spend a bit more time on protecting your GDV. So things such as being realistic around that. So what we're looking at here is protecting your GDV over maximising it. Now, there is a temptation, and we speak to many clients, in fact, one this week, whereby clearly, I fully appreciate why you would want the maximum GDV. You're going to want it because that delivers the most profit. But then it can come with a nasty sting in the tail at the same time. And the reason we've been sort of talking around affordability and some of the downward pressures that the economy is feeling, you may be able to get and ask more for a property, but the question is that the further up that scale the value goes, the smaller the market is to actually be able to buy that in the first instance. So you may find yourself in a scenario where you can't shift on your finished product, if you like. Okay, so we just want to talk about that. Other things we are looking at is reevaluating your exit strategies. Okay, so with regards to protecting the GDVs, the way we look at it, there are 3 separate phases that happen within any development. So you've got the purchase and the planning element. Okay, so if it requires planning, there's a planning process to go through. And you ultimately need to buy the opportunity. There is the build phase, okay, which a lot of focus is put on there for good reason, because that can get wildly out of control very, very quickly. We talked to a client about 3 or 4 weeks ago, and that happened. They got let down by their builder, and it's completely ruined the transaction for them. It's probably irreconcilable, in fairness, on that front. However, the third phase and the last phase is something that often gets overlooked and neglected, which is the sale or indeed the refinance process. Now, whenever we talk to clients, we spend a lot of time focusing on the exit and the refinance element, if it's going to be a build to rent or something along that nature. Even if it's going to be a sale exit, we will also run the numbers on a refinance. So if it is a slow moving market, or if there is less demand for the product that you've just built, then you have an alternative exit strategy. Okay. Now, if you're already in a deal, then some of the things that you can do to practically help yourself in the third phase, because that's where we see a lot of people get stuck. They've rattled through the build, that's all gone swimmingly well, and then they're stuck with the end product and can't move that on. Now, the consequences of sitting on completed assets means that you've got potentially borrowing in place and you're paying what can be a heavy price for that interest to just sit there. So the key here is how can you exit that and get that money repaid as quick as possible. The interest that you pay goes straight to the bottom line on your profits. So any interest you can save is a direct return on profit. So your margins are going to increase as a direct result of that. So we can't emphasize that enough in this particular scenario. So the ways that you can do that are going to be ultimately about marketing the scheme or the product that you're building or making as soon as you possibly can. So we were working on a scheme local to us where they were building 15 executive homes. And they were ultimately relying on word of mouth to get these sold. They were well known locally and so on. That property is probably on its 4th reversion of the same finance because it's been slow moving. Things they could have done to speed that up would have been to get it sold off plan. So get it marketed as quickly as possible. Whether you're selling or whether you're renting, you want people lined up to buy or occupy your property or your product as soon as you possibly can. Okay, so things like CGIs are a great way, artist impressions. You want to sell that as quick as you possibly can. If you can secure deposits and you know that you've got an exit lined up for it, that can give you a lot more comfort in that as well. Okay, so I can't stress enough that sales refinance period is the one that we see most clients get stuck in for longer than they anticipated, and that means they're borrowing the money for longer than they had budgeted for, which again feeds back into what your net profit is. Okay, so reevaluating your exit strategies. Yes, you can squeeze your GDVs, but as we said, that does come with the negative impact of affordability. So you may actually be shrinking your pool of potential buyers by pushing your property values as high as you possibly can. So it comes back to what is the consequence of escalating that in there as well. Okay, so is it worth the extra squeeze, the extra 20,000, if your buyer pool shrinks by 30% as a direct result? Okay, I use them in numbers as example just to emphasize the point as what you give with one, you take away with the other. Okay. The other thing to consider as well is around lenders. okay, and their appetite to support beyond your agreed facility. So if you are in a position whereby your build doesn't go as planned or you can't sell as quickly as possible, you've got choices. You can either negotiate with your existing lender or you can subsequently refinance it to something called development exit. Okay. However, as I mentioned, finance costs are a direct cost and will impact your net profit. Therefore, the cost of refinancing or extending a facility is ultimately going to erode what your profit is going to be. So again, have that understanding of whether that is a viable option going forward or not. Okay. Adjusting your build program durations, as we've already mentioned, around supply chain, the word I'm looking for is supply chain stability, cost of materials, labour costs. All of these are impacting. Personally, I've had a scenario where we were looking at, I think it was 5 attempts to get an electrician out to the house to do some work. So the trade isn't there as much as it readily was. So having a really strong build team or a trades team that you can call upon, but making sure that your build programs are realistic in what is going to happen. If you're doing new builds or anything like that, also taking into consideration the weather. So as I used the example as previously where they were building executive homes, you went through a particular wet summer, that completely slowed down the build process on that as well, which had a negative impact on their ability to build the property, to subsequently sell it, and so on and so forth. Okay, so impact on your pipelines and projects, it comes down to ultimately your exit primarily. And as I say, some of the ways that you can push that forward is get it out there marketed, get it out, get your buyers lined up as quickly as you possibly can. Engage with agents where possible. You know, you've got the billboards and those sorts of things that can go up and market it around the property. Local knowledge is key, so push it out there as much as you can. If it is rentals, don't wait until the property is ready to be shown around and the carpets are in and so on and so forth. You know, it doesn't cost that much these days with the advent of AI to create visuals and so on, so that you can actually sell that and have people waiting there. You know, if you've got a queue and you've got a demand, then you hopefully will negate the issue around things such as rents going backwards. Hopefully they should go more in your favour than the opposite on that as well. Okay, so that's a little bit around protecting your pipeline projects. The exit is key. Can't emphasize that enough. So making sure that you can move through that third process as quick as you possibly can will have a real strong impact on what you can save in terms of financing costs and interest, which ultimately you'll find it then go down onto your bottom line. So other thing that we're looking at then, and I talk about the GDVs, is in relation to the end value. We often have a conversation around when times get difficult that you should stress test your deal. Okay, now stress testing is a fundamental part of this. However, we have a lot of conversations with people who will pick an arbitrary number. So in mortgage terms, a lot of people would say, oh, I stress test my interest rate at 7% to see if I can still afford the mortgage and will my rent cover it and so on. But these numbers, as we've seen, can change a lot in a short space of time. So picking an arbitrary number is I would argue, the wrong way to go about it. In this particular scenario, what we're trying to show is that what you should be doing instead is testing your transaction, your deal, until its point of failure. So the idea is understanding at what point does this cease to work. You cannot control the outcome in terms of the value. The market may shift against you. All sorts of things may happen which could negatively and positively impact the value of the property. So you can't control that. When we speak to clients who say, I need the property to be worth X, you know that they've kind of gone about it the wrong way. Okay. What we can do, and I'll show you this example here, is a deal on how we would potentially stress test the GDV on this one, and this applies to both the build cost and the purchase cost as well. Okay, so in this particular scenario, we've got a purchase price of 200,000, build cost of 300,000, and a GDV end value of 800,000. So a nice little deal that sits there. Okay, So what we've done in the table below is run different metrics across the scenarios that if the property doesn't value at, or meet your expectations on the refinance or the sale, okay, is what are the implications of that based on varying debt levels. So the GDV 700, 600, 500, 400. So we've done 100,000 increments. You can do obviously much smaller increments depending on what the deal actually looks like. I've just assumed a debt value here of 400,000. So the whole deal is 500. You've borrowed 400 to do that. That may be a mixture of investor finance. That could be bridging finance. Could be your own cash, whichever you wish to badge that up. And what we can see here is then if you were to retain the property, what that would look like in terms of mortgages, okay, on a basis of a 75% loan to value mortgage. So on a GDV of 700,000, if you were selling, not really an issue because your debt level is 400,000, there's still 300,000 profit or net return back to you. How much of that profit remains to be seen. GDV 600 with a debt value of 400, we're down to 450. There's 200,000 and so on. And that obviously makes sense that it goes all the way down to 400,000 because your primary objective when we look at it is can we repay your debt? Okay, you may not make anything, but you don't want to be in a position where you can't repay your debt that you've taken on. Now, if you're retaining this and you were looking at a mortgage, then we have to consider that you don't get 100% of the proceeds back when you refinance. Instead, it's 75% loan to value, so you will be leaving 25% into the deal. Now, in these scenarios, we can see on a GDV of 700,000, 75% loan to value is 525 that you would expect to get paid back. You pay off your 400, and then you'd be net positive 125,000. Then 600,000 takes down to 450. You can see now the margin's getting a lot closer as to what you want, and then you go down to 500. It's 375. It's now underwater in that regard for paying back the debt, 400 and so on. The point here is, as I say, running the metrics so that you understand what is my point of failure, how much slack is in the end value that I want or need or require. And if that margin is small, I mean, this particular example, obviously it's quite a large margin, so there is a big room for error in any assumption on the end value. Okay, as these numbers get tighter, then clearly that room for error becomes smaller, and the risk that sits within the scheme becomes way greater. Okay, what you don't want to be in a position is obviously that you can't refinance or sell for more than the debt outstanding is. Now, if you couple that with what your profit is going to be, so I haven't accounted for any profit in this, the time that you've taken and the effort and the energy and everything to make this deal happen, but you can only pay back your debt, then you would have made very little in the process, so you need to factor that in as well. So what is it that I need to get out of this deal to make it viable and worth my time? And what does that mean in terms of what GDV I need to achieve? If you are finding that you're doing these in increments of say 10 or 15,000 and you're only one or two steps away, then you want to be asking yourself, what's the viability of this? Can I ride out any valuations that don't go in my favor or don't set up in my assumptions? We often see scenarios where you will do the development finance and the scheme will be valued and they will comment on the GDV at that juncture. And let's say they comment it's 800,000. When we come to do a remortgage, the valuer who remortgages it comments that the GDV is 700,000. Just because you've had the GDV on the valuation in the first instance doesn't necessarily mean that translates into value on the refinance, nor does it necessarily mean that it translates into what you will actually achieve at sale as well. So just bear that in mind. So the message here is don't just pick some arbitrary numbers that you can say it's 6% return and so on. Actually test all of your layers until they fail so you can see what is going to happen. That will give you a good line of sight into the future. So if you hear of news that something's not going in your favor, you can understand how much room and time effectively you have to either exit the deal or whatever you need to do to make in the necessary adjustments. Okay, so create some tolerance in your project by doing this and understanding, and are you comfortable with the level of risk and effort that you're going to take, and is the margin, is the juice worth the squeeze, so to speak, in that regard. So hopefully you find that helpful. As I say, this is how we would encourage our clients to do it. Don't just pick a number, take your scale, understand the tiers at which you can tolerate the risk, and from there then you can decide whether that sits within your risk appetite to then subsequently take it forward. Okay, Gareth, over to you.
Thank you, Mark. So just moving on then, guys, to looking at what kind of deal structures are going to work going forward. So these are some of the things that we are seeing in the market, some of the deals that other people are doing, and how they can help you, really. So the first one is demand-led development. Now, this for me is probably a bit of a game changer, where you are ultimately you've got an exit guaranteed before you do the deal. We're seeing a lot of this with the housing associations at the moment, where you can enter a package deal with the housing association. It is a little bit niche, but it's not, if you're developing and you're developing at scale or want to develop at scale, then this definitely needs to be something that you're considering, where you can let's just take arbitrary figures just to keep it simple, where you might be building a block of 10 apartments, and the housing association will say, we'll buy those off you at 250,000 per apartment, as a job lot. So you can go in, you sign a contract, you get the planning, and then you sign a contract with the housing association that they will buy those off you before you even start doing any works. So that means you know exactly what the spec is, because you're going off their spec, their specification. You know what the build is going to be. You price out the build, and then you do the project in line with the housing association, and then they will buy those off you. So it takes, from a lending perspective, it makes the deal far easier, because you've got a guaranteed exit. It's far easier to finance. There's no guesswork around GDVs. There's also a limited, it's a lot more structured in terms of the end. You haven't got what's a marketing period. Are we going to phase the sales? You haven't got any estate agent costs. You haven't got 10 lots of solicitors costs in the sale, for instance. So those types of deals are far better. There's also plenty of providers out there that will look to do these types of deals, the charities. We've seen the funds we've mentioned earlier on around social and affordable housing, the amount of money that's being pumped into that. So this is probably a big growth area. There's a lot of government money being thrown into this. And in certain parts of the country, this works particularly well, because the GDV that you can get from the housing associations or social housing providers are actually probably better than what you would actually get on the open market. And there isn't necessarily a huge demand for some of those. So that's something to bear in mind. We also have, if you are in the middle of a development, for instance, we've got clients who are working with specialist providers like care providers and supported living providers, who will take a property on a long-term lease. And so they, build to rent. They will take a property. Let's use that example of a block of 10 flats. They will take the 10 flats on a long-term lease, giving you a guaranteed exit. You know where you are rental-wise. You can refinance, pay off your debt, and consider selling that as an investment in the future. So those are some things that you might want to consider in terms of trying to get really understanding what is the demand for the properties that you're trying to create. Lenders will, as we go into next year now, lenders will become a lot less keen on speculative deals. So again, this goes back to the first point: is it demand led? So is there demand for these types of properties in these locations? So let's take, you've found a bit of land in a remote area that you can get planning on, and it's quite rural. You're not going to build a block of flats in a quite a rural area that there's no real demand for the end user. So There might be things like that, or are you building on the hope value that you're going to get people going to buy these 4-bed detached houses in an area where there isn't really a need or demand for those types of properties. So being a lot more specific about what your product is and what you're trying to produce, and there is demand for it. And then experience. So lenders now, where there's possibly deals going to be squeezed, there is plenty of liquidity. So lenders do want to lend, but they want to make sure that they're lending to the right people. And ultimately, lending is all about, am I going to get my money back? And so, they want to see that, one, you've got the experience to do the deal that you're trying to do. And so if you're going to go from, you might have done one buy-to-let BRR deal, and then you might want to build 100 apartments. There's quite a significant jump between those two. And it's unlikely that, unless you've got a real good story behind you as to why that would work, that's probably unnecessary and unlikely. Whereas if you are a building contractor and you've been doing, for the last 10 years, you've been building 100-story block, 100-unit developments for the last 10 years, and you can evidence that, and you were very involved in it, whilst you may not be able to fully do the development on your own, if you've got other partners in there with you to joint venture with, then potentially that is something that you could look at. So that it is all about it, but they want to see you building your, staircase in your experience. So slightly going up from a small number of units, a couple more number of units, and just getting bigger and bigger as you go along to show that you can manage the various aspects of a development. And then those two touch on to the next 2 points, really, is power team, who are the main contractor and what is their experience in doing these types of deals? Who's the project manager? For me, one of the most important people on a project is the QS, because, if you've got a bad QS, that can really impact the project, and you want to make sure that that's not somebody that's on your team. And then we're talking about the professionalizing of landlords and developers, having a really strong admin function, a strong paperwork trail, and a really good financial controller, so that when you're drawing down on developments, everything's in place. And I know Mark will touch on that a little bit as well. And then finally, in terms of deal structure, it's what kind of deals can you do? Are there deals available with landowners where in the past they've just wanted to kind of offload, or they've been land banking? Now, how can you mitigate risk in moving forward with deals? So don't necessarily buy the land speculatively, which we talked about. Are you able to offer the landowner a profit share, maybe? Are you able to do a lease option so you can agree a purchase without actually buying it? Could you do a conditional exchange, the condition being subject to planning? Could you do a deal, and we've done a couple of these, where the landowner is happy to allow you to take through the development journey with a second charge, and they'll keep a second charge on the property and the land. You build out, and then they get their money at the end, and you might be able to offer them a slightly bigger piece of the pie. So that would be maybe more of a JV with the landowner. But there's plenty of these deal structures available. It's just understanding what it is you're trying to do and how the best the deal works. But ultimately, how do you mitigate your risk? And that's where you get creative with the deal structures, and just get advice from people who are doing it, or people, solicitors, talk to us. We can help point you in the right direction. We've got a bit of experience ourselves on different structures and what can and can't work as well from a finance perspective. Mark?
Yeah, awesome. Thanks, Gareth. So just leading on from that, and I'm just conscious of time, so just going to speed things up a little. Now, impact on your pipeline projects. Okay, what does this actually mean, and how can you sort of mitigate some of these issues around the structure of the finance? So we've spoken about not getting into deals without knowing what your exit is going to be. Gareth mentioned there about buying property that is not subject to planning. Okay, the planning system itself is challenging. I know there is PD. We get a lot of people asking us about PD. However, it is still a planning application. and it still has to go through a process, albeit a faster, quicker process in England than it is in Wales. Everything in Wales is a planning application, effectively. So buying things speculatively with the plan to get planning is one of the quickest ways to spend money in terms of finance. We can fund these deals. However, you could be sitting on bridging finance, which is a little more expensive. Well, it is more expensive than a mortgage, and you could be sitting on that for a large period of time whilst you're trying to secure your planning. So avoid that as much as you possibly can. Try and buy subject to planning. Cash flow, how do we cover for that? So be prepared for your drawdowns. If you are taking development finance, the portion that helps with the refurb is always paid in arrears. So you would pay, let's say 10, 15, 20,000, then you would draw down the next part and so on and so forth, okay? One of the biggest drags on that process can be not being prepared for your request for the funds, okay? So what we're talking about is having your invoices all collated together, engaging with your QS if there is a QS, engaging with the lender if they're doing just a manager coming out to check with you, making sure that you are ahead of your curve. So prepping out your cash flow. Most projects follow the project S curve, so it's little spending at the beginning, little spending at the end, and in the middle is where the majority of the spending would happen. So try and map that out as best as you can. We do have access to calculators on our website that you can have a look at, and we have an actual S-curve builder so you can see what your project may look like in terms of actually needing funds. So get ahead of that curve, if you like, in regards to how you request the funds. Most lenders promote that they will give you the money in 48 hours. That's great as long as you're organised. If you're not organised, that could be anywhere up to 2 weeks, and you don't want a site to stall, or you have to beg, steal and borrow just to keep that site going, because once you lose the trade off the site, it's going to be exceptionally hard to get them back, as we all know. So that's something to bear in mind as well. And then as for structuring the finance, Gareth spoke about some more creative strategies to structure the deal. And that also bleeds into structuring the finance as well. So all I would say in regards to that, and there are many ways in which you can be creative in how you engage with the vendor to include them in it, and vendor finance and these sorts of things. Always, 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 if you are thinking about using a development funder or a bridging lender of any description, you have to remember they will want first charge over the security. Okay, whether that, so the target asset is going to be what they're going to ultimately want first charge over. Okay, so if you are going to engage and use something that's creative in terms of your finance, you can't offer that same first charge to the vendor to keep them happy as well. So you're going to have to try and knit these things together. We can obviously help with these conversations if you are thinking about how I can do these things and what's the impact on your borrowing requirements. But just remember, they're going to want first charge. Therefore, you have to think of other ways that you can secure the vendor. That could be personal guarantees, possibly a second charge after the first charge. You may have other assets and so on and so forth. Okay, so that's just something to bear in mind. Structuring the finance, there is access to something called mezzanine finance. Okay, that is effectively a second charge loan on your development. It is priced accordingly. It is more expensive. Again, the thing to remember with all finance is the cost of the finance is direct to your bottom line. Okay, it doesn't hide anywhere else. The cheaper you can borrow the money for, the more profit you're ultimately going to make. The less time you can borrow the money for, the more profit you're ultimately going to make. So, as I said, conscious of time, so I didn't want to dwell too much on this. I also noticed that the bullet points don't quite match what I just said, so apologies for that. But as I say, be prepared in your drawdowns. Try not to overcommit yourselves in speculative projects in terms of planning. You can get bogged down in planning whilst you've got expensive debt sitting there in the background. And if you are going to do anything creative in regards to the vendor and try and involve them in the process to keep your borrowing costs down, just remember that the lender is always going to want first charge. Over to you, Gareth.
Thank you, Mark. If you can just move on. And again, I think we'll just skip we'll skip that slide just for time.
Okay.
So just want to touch on, just kind of wrap up a little bit around what we are. Hopefully give you guys some time for some some questions. So apologies, we've run a little bit on. So ultimately, what this comes down to, this is what we've created it as the 3 C's of property investing finance. So this is where we want you to be primed. Obviously, there's a bit of a play on word there, but based on what we do. But we are trying to, there's 3 C's of property investing that we see is credibility, clarity, and confidence. Now, first of all, if you've got clarity on what it is you're trying to achieve and why you're doing it, because property development is not easy, it is difficult. If it was easy, everyone would be doing it. And of the people that are doing it, there aren't lots of people that are doing it successfully, and you can lose a lot of money by doing it. So you do really need to be careful. And that's why we are quite realist. We can come across sometimes as negative, and we tend to burst more bubbles than we don't. But we don't do that on purpose. We do that purely for the sole reason of trying to protect you. And if you know your why, when the time gets tough and you're told no a lot, and it does hurt, but you got to get up and rub yourself down and keep going again. Knowing your numbers, this is really, really important, and especially when you get into development, there's so many moving parts. Knowing your numbers and having a clear investment strategy, what is a good deal for you, is so, so important. So that's the starting point. And then when when you're really clear on what your objectives are and your goals are and your metrics are and what makes a good deal, it's far easier for you to be credible in front of vendors or agents, because you are really clear on the types of projects that you're looking for. Is it land deals that you're looking for? When you're talking to vendors and you're trying to put a land deal together, you know your numbers, and so you can be confident and credible at the same time. When you're proposing to lenders, this is my investment strategy, this is what we're going to do, this is how we're doing it, this is who we're doing it for, this is what it's going to cost. All of that builds credibility. And when you've got clarity, and then third part is confidence, when you're really clear on, what you are trying to do, your numbers and your strategy, that gives you some confidence that you're not going to buy things for the sake of buying it. It gives you self-belief, and actually you won't waste time and focus on trying to do deals that don't meet your strategy. So when you won't get caught by the shiny penny syndrome. So when a deal crosses your line and it's for 4 houses, and there's a 20% profit margin, if your clear strategy is that you don't do any deals that are less than 8 properties, you can literally just bat it away and not waste any time in it, because it doesn't meet your investment strategy. Whereas, some people who aren't that clear or what their metrics are, or you might have a deal that comes across your table and it's 10 units and it's an 18% profit margin. You think, oh, well, actually I wanted 20, but 18 will do. What we really, really want to focus you guys on is making sure that there's plenty of wriggle room in there, because what we've seen is the changes in the inflationary pressures over the last couple of years has had a huge impact on deals. And like Mark said earlier, the key part of getting good deals over the line is the speed from taking the finance or completing on the property, so that you're paying some sort of finance or you're burning through your own cash to getting the deal over the line. You're paying interest. The quicker that you can get through that deal, the better. And the longer it takes, the more of your profit that's eaten up. So you don't, if you're already starting on tight margins, that doesn't give you much leeway, like Mark shared in his graph earlier, for things to go wrong, for GDVs to come down, for costs to go up. And it makes it what was a tight margin deal not a good deal potentially. And like I said earlier, again, where people have been reviewing those deals now, deals that they did a couple of years ago with a £500,000 profit margin, now running those numbers again on today's figures are £500,000 loss. So you do have to be really careful and just get as much information as you can. Speak to people, network, find out what people are doing in your market, in your area, because it does change from location to location. So hopefully that's been helpful. Like I said, conscious of time. So if anybody has got any questions, then please raise your hand or chuck a message in the chat, and we'll open the floor. Do you want to just put on to the next slide, Mark, so anyone can, might be some pointers in there about things that people might want to do. They might have a current project that they're working on, or a mid project that they're having some issues with, or they'd like a question answered on, some upcoming acquisitions, maybe something that's in the pipeline, something they don't understand about finance structure. This doesn't have to be related to the budget or what we've talked about tonight. It could be any mortgage or finance related question, costs, planning issues, or you could just, if you've got any of your own thoughts on the budget and the impact on the investment market, we're also welcome to hear your thoughts as well. Nothing from anyone? No worries. I think one.
Oh, yeah, we've got a couple of hands that I can see waving. So we've got Linda. Feely, Linda, do you want to unmute yourself? Oh, sorry, 1 second. I think I can unmute you here. Bear with me a second.
Hello.
Oh,
Hi.
Linda, right. Arabella, we'll come back to you in a second. So, Linda, do you want to ask your question?
I was going to ask, what are the fee differences, etc., to commercial finance than normal, like residential, etc.? How does it sort of finance-wise differ, and what fees are involved, etc.?
Yeah, more than happy to answer that. So when you say commercial finance, are you talking commercial mortgages?
Well, yes, yeah.
Yeah, okay. Yeah, so commercial mortgages are priced higher. Everything in lending is priced based on risk, and commercial presents a higher risk than residential. The reason for that is because of market cycles that happen in business, whereas arguably everybody needs a house. So bear that in mind. Fees can range anywhere. So you'll have an arrangement fee in the same way that you would on a buy-to-let or mortgage, 2% plus, anywhere up to 5%, depending on the lender and the scheme or the property that you're purchasing. And then the interest rates, we said the average five-year fix was around 5% currently on residential. You can expect that to be around the 8% mark on commercial. So it's not extortionate. It is more expensive, but it's comparable. There isn't that much of a difference when you weigh it all up. So a few things that you probably will need to consider, is going to be solicitor costs will be greater because they will be reviewing leases as well. Okay, so it's not as straightforward as a normal conveyancing at £700-800. You can expect 1,500 to 2,000, if not slightly more, depending on the complexity of it. The due diligence that goes on in the back end of the purchase is more detailed on commercial. Valuation fees will be greater as well because there's more that goes into it in terms of the valuation. So if you can imagine commercial, when you're trying to do comparables, you're looking for other assets that fit that, and it might be nuanced and so on and so forth, whereas it's easier to compare two full-bed properties and that have sold in the last 6 months. Commercial property doesn't move as much as in liquidity, so they don't sell as much, so there's potentially less comparable evidence. Still need to just spend a bit more time on the valuation in that front as well. And you will never get in commercial, you currently will see, if you do a buy-to-let, and it's a straightforward buy-to-let, you'll have something called a short-form valuation, which is just a one-pager that we see. You'll never get that in commercial. It's always a detailed, very detailed, in fact, report on demand, SWOT analysis, comparables, everything. So expect to pay more in probably every aspect of it.
Can I just add to that as well, Linda? I'm not sure if you've seen our podcast, Prime Property Finance podcast. There's a link to it on our website, but we do cover off commercial mortgages in quite a bit of depth there. So if you wanted a bit of a deeper dive on it, then I'd probably point you to that to have a listen of that.
Yes, yeah, I will. I just wondered, like, if I went for it's an HMO and it's producing a fair bit of income, and I wondered if it was possible to get a buy to let because it's already being let, or does it have to be a commercial? And how much deposit do you have to pay?
So HMOs are different to commercial. Okay, they are
Right.
different to a buy-to-let in so much that, so they're still residential, but they sit in a class of their own, in effect, depending on the size of the HMO. So you can have minimos, which are small HMOs, right through to 20-bed HMOs. So there is a
This was a
spectrum.
9.
9-bed, okay. So it's going to sit in the larger field, okay. 25% deposit is quite standard, so they will still fit the criteria in that regard. In terms of the rates that I quoted, they will differ. So you won't be paying the 8% are reserved for true commercial, retail, and that sort of place. You can expect to pay a bit less on the HMO stuff, probably around the 6.5% to 7%, depending on the size of it. As you say, it's a 9-bed. You're going to want a commercial valuation, I suspect, on that. So the commercial yield, so it would be a yield-based valuation. So what I said about the valuation probably stands. Around cost, and equally the conveyancing costs will probably stand as well, because if it's 9 beds and you've got 9 ASTs, you've got 9 of everything really. So just to have a look at that as well. So yeah, the interest rate will be less than I quoted, but the other costs will arguably be comparable.
So with a commercial mortgage, you still have to pay like the stamp duty and stuff.
Yeah, so the taxation of a property is unrelated to the finance, so that's a standalone. So this would be a HMO mortgage as opposed to a commercial mortgage. Okay,
Right.
and the stamp duty is a separate conversation altogether. That's
Right.
going to command the tax per, whether it's in England, Wales, etc.
So just to point on, and we get this quite a bit, is because what we're talking about is residential versus commercial. So if you think of a property that is residential by nature, it's a property that somebody lives in,
Mm-hmm.
and but there are the HMOs in the main are where because we hear the words commercial valuation, we think it's a commercial mortgage, but it's not really. It's a residential mortgage with some commercial elements to it. So the only commercial element on a HMO really is the valuation and the type of and the solicitor's fees. The stamp duty will still fall in the residential element, whereas if you were buying a block of 6 flats or more, whilst that is still residential, that would fall into commercial stamp duty. Or if you were buying a semi-commercial, maybe a shop, a hairdresser's on the ground floor with a HMO above it, that might fall into, well, that would fall into commercial stamp duty, which is generally a little bit cheaper than residential stamp duty. So there's quite a few nuances in there, and some of it is to do with the terminology, and it is easy to get confused about it. So yeah,
I
no
do.
issues with those questions at all.
I do have a 12 block of apartments, 2-bed apartments. So it would be a commercial. Would it be for that? I plan to split title if I can, and maybe rent them off singularly, or put them on the market and to sell again.
Linda, if you don't mind, I think it's probably worth you jumping on a call with us to discuss
Yeah,
some of your personal details in a bit more detail, because we're jumping around a little bit, and
yeah,
whilst yeah, if you don't mind.
yeah,
Um,
that's fine.
Guys, is there anybody else? Thank you, Linda. Is anybody else have any other questions? I can see Arabella had a question. Do you want to ask the question? Is it easier to get the context across?
Yeah, yeah. I wanted to ask if a mixed-use property with a ground floor shop and a flat above would be considered as a small development, and so probably What I mean is, if you title split this property as a freehold and as a combined, residential and commercial, that would be then a small development.
Mark, do you want to take that one?
Yeah,
I've heard you answer this question so many times. So
yeah, no, that's fine. So there's two elements to this, really. Is if you want to keep it as mixed use, okay, there's a question over whether it's considered mixed use or commercial. Now that will depend on the split between the residential and commercial. Typically, if the commercial is 40% and above, then it falls into the commercial sphere, and it will be a commercial mortgage you'd require. If you split the title, then you've got two individual properties on your hands. The residential can be treated as such, as in a buy-to-let. The ground floor will then be treated, obviously, as commercial because it's no longer one unit and we no longer mix in the use. The bit to be aware of on the commercial is that you are limited in terms of the actual valuation on lenders. So many lenders have a minimum income criteria, a minimum property value for commercial. And that's usually at around about 200,000. So if a lender is lending at 150 minimum loan, 75% loan to value will mean the default value needs to be 200,000. The types of properties that you're talking about, often the retail unit isn't worth that, and therefore you can have trouble with the mortgage itself. So it comes back to why and what are you trying to achieve as to whether that is a sensible option to take in regards to, do you split title, do you keep them as one unit, because that will ultimately impact what your funding options are going to look like.
Thank you.
You're welcome.
anyone else have any other questions?
Yeah, just a quick one, if that's all right, Gareth and Mark. It's just around the point you made about GDV, and I was thinking about like property without planning is probably, land is cheaper to get hold of, but I guess there's an inherent risk if it doesn't get planning. You've essentially just got potentially paddock land with a minimal value. Are you seeing more people trying to take a punt with it, or do they need to go through that problem of acquiring land that's already got planning? I guess there's pros and cons of both, but you take a bit of a risk, or you potentially might erode your margin a little bit, particularly with a lender stance on the value of that land. And talking about not overinflating, but that possibility of relying too heavily on a higher GDV and with those risks.
Mark, do you want to give your thoughts on speculative land purchase? I've got some thoughts, but do you want to just cover that point off first?
Yeah, sure. So I think the first point is going to be, around, do you buy land without planning? If it's your own cash, then what's the harm? You don't owe anybody anything, and you can leave it sit and land bank it if you like until such time. I know that is a strategy for some that sit on the curtilages. They'll perhaps acquire this, so it'll fall into the LDP. That's the word I was looking for. So perhaps you might fall into that, and then the value becomes that. Also, and I'm sure if you've had conversations with people that own land, the residual values, a lot of people who sell land massively overvalue it as well. But more to your point around, are we seeing people do it? We're seeing less, I would say, do it because of the inherent risk of not actually being able to get the planning. If you put a loan on there, let's say the land is £100,000 for argument's sake, and you put a loan on there for 50,000, 50% loan to value is the max the lender will do at 1% a month. That is going to rack up quite swift over 12 months. And if that planning, we're in fact, I think the main point here is we're seeing planning taking anything from 9 months to 3 years. If you've got debt outstanding on that for that period, it could, it depends what your resources look like as to whether you could actually ride that out. So, subject to planning seems to make a lot more sense.
Yeah, thanks for the question, James. I'm assuming, are you looking to invest in Wales, developing Wales specifically, or is it?
Really thinking from a client perspective, because the bulk of them, that I would speak to would have land with planning, but occasionally you do see something come up that it's allocated. So there's a higher GDV with that, but of course, from a lender perspective, it's always a little bit on the twitchy side that, what's going to happen, what's the development going to be like. So I was just thinking really about the difficulties around funding with that. That was kind of my thought process, and just wondered if it would be helpful for everyone to sort of understand that. Probably a simplistic question, but just something just seen on a few occasions recently.
Yeah, my thoughts are first and foremost is right. If you present a piece of land, right, what's the actual opportunity here to get planning? So is it inside the LDP? For those who don't know what the LDP is, it's the local development plan. Now, every local authority has, if you go onto the local authority's website, you can type in local development plan and your local authority, and it'll give you a map of all the areas which are included for residential dwellings, if it's in this case. But if it's not included in the LDP, generally they update them every 10 years. I know a couple of our local authorities have just updated theirs. And what you can do is you can apply for a piece of land to be included within the LDP. Now, that if it's not included in the LDP, it doesn't mean that you won't get planning on it. You can actually, and especially if you do work with a housing association, for instance, on a joint bid, you may get an exception passed from a planning perspective if it's of a certain size and it's just on the edge of a village or town boundary, which is why. So the reason LDPs are brought in. So let's say you've got, just to keep it really simple, you've got Swansea and Cardiff, and there was nothing in between. Then if you had two areas, one and you just build, all of a sudden those two become connected. So the reason the LDP became in place was to keep towns and cities and villages within a certain containment, and those are now slowly edging out. And if you can clearly demonstrate why a plot should be in there, then you've got a strong argument. Now, my first port of call would always be to have a conversation with a planning consultant, because planning consultants will understand what areas are likely to get them. So that's does it fit within the LDP, and is it likely to be favourable? What's the access like? What's the infrastructure like? And then you've got to look at things like, is it in a floodplain? It could have all the infrastructure, but it could be in a floodplain and it'll never get built on. In Wales now, we've got SAB, which brings another issue. There are the other issues around phosphate levels in the water and nitrate levels. Some local authorities have put a complete ban on planning applications in those local authorities until those nitrates and phosphate levels come down in the water. So that's an issue. So if you're speaking to people who understand that, that would help. Now, what would I do from a developer, with my developer hat on? I would be trying to minimize my risk as much as possible. So how do you do that? Lease options. So you can agree a lockout period or a lease option with a landowner to say, well, look, I really want to buy a land, but I only want to buy it, really if I can get planning on it. Now, to take a piece of land through a planning journey, ultimately, if it's agricultural or if it's greenbelt or whatever it may be, it's not really worth a lot per acre. Whereas if you can get planning, it's worth more. So you can say, look, Mr. Landowner, what we'll do is we'll agree on the basis that I can get planning, it's worth more. We'll agree a figure now, but I'm only going to buy it if I can get the planning. So, but to take it through the planning journey is very expensive. You've got to get all of the ecological surveys, bat surveys, tree surveys. Everything needs to be done up front now. So that the cost to take a certain sites through planning can run into hundreds of thousands of pounds. So you'll say, well, I'll take the risk on planning and I'll do that at my expense. And then if we get it, then I'll exchange and carry on the purchase. But it locks them out from being able to sell it to somebody else once you've got planning. But you haven't bought the land and gone through the planning cost risk to then find out that you can't get the planning.
So just to add, sorry, James, just to add to that as well in regards to the financing side of things, is it'll ultimately require two types of finance. Okay, you can't get development finance because you don't know what the end position is going to be. So very often within planning, you'll put your application in and then it'll come in, it'll be amended and tweaked. You might need to lose a unit, add a unit, lose a bedroom or whatever it may be. Therefore, your GDV is going to bounce around quite a lot. Therefore, you can't get development finance because you can't assess the end, what you're actually going to build. Therefore, you have to rely on bridging to purchase. And then once you secure the planning, you have to refinance again and attract all the associated costs that come with that. It has to be revalued with the GDV. You have to repay for the financing costs, the solicitor cost, new loan documents and everything that comes with it. So I would argue it probably needs to be a very, very attractive proposition for you to want to do it with speculative planning, because the implications just from a financing perspective are substantial.
Thanks, Mark. That's really helpful. I suppose what I'm taking from this is the purchase of land with planning is going to be a bit more expensive. So there's probably no shortcut around it, because if you buy land without planning, there's all those various costs you said, and then you got the development costs as well on top eventually, which going up. So I guess margins are being somewhat squeezed for developers. So that the proposition being attractive, I suppose that's the crux of it, isn't it? Probably no shortcuts with this now, no easy way around it, an awful lot of planning and timing's involved, and time ends up sort of costing. So just really useful to sort of summarize everything. So thank you for that.
No worries. And just to add to that, two things really is one, and I've mentioned this, is I've said this to a number of people, you could give me your land and I could still not make money on it. And that's trying to get vendors' expectations in line with the cost of, to build a house these days. If you give me the plot of land for free, it might cost me 200 grand to build a house, which is only going to be worth 200 grand. It just doesn't make sense. And so why would you go through that risk? So that's the first point, is even with vendors' expectations and landowners' expectations coming down, some projects just don't work. And so you need to be able to know when that is, and knowing your numbers helps with that. And then the second part is around value engineering. So where you might look at a plot and say, well, I'd really like to build 4 detached executive homes here. Actually, that site, that doesn't work. Whereas if we could put a block of 12 apartments on there, the individual values are going to be lower, but the overall GDV is probably going to be higher, and the build costs are probably going to be a little bit lower as well. So it's just understanding how you can take a site and run through the different options for that project. And one might, somebody, and this is where people are making money, isn't it? Is they're able to spot opportunities that other people aren't. And so many, there's been things sat on the market for a long time that people are picking up and making money on, that it's been there in plain sight for everyone to see, but they've just understood what works in the market, what doesn't, and have been able to do the deal off the back of it. Thanks, James. I can see Linda's put a message in the comments. If they refuse and the council is not on target with the supply, then it's worth sending it to appeal. More often than not, it will get through. And as they have supplied a certain amount of properties per year, or our council is not on target. I think you could say that about any council, Linda, so I totally agree with you. The difficulty is the time it takes to go through the appeals process. Most local authorities we're seeing aren't delivering. Well, first and foremost, most local authorities won't even accept a planning application now if you haven't done a pre-app. And a pre-app should be turned around in 4 weeks, and very rarely are they being turned around in 4 weeks. And a planning application should be turned around in 8 weeks, and that's not being done. So what they're doing is effectively making the 4 weeks and the 8 weeks as a 12-week planning application, double fees. So they're dragging, and they're not meeting those targets either. They are understaffed. I'm hearing that they are now starting to ramp up staff and retrain and rebuild the planning departments, but yet that still remains to be seen. But ultimately, the government is saying build, 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 and we want to create all these homes. But the reality is the difficulty it is for investors and developers at the front end to get things through planning. The costs of all of the surveys and engineers and everything else you need just to submit the application is frightening, and it puts people off, and so it does make that market more difficult to get into at a starting point, because you have to take some risks and that's without even buying the land. But yeah, a lot of things are won on appeal. I'm not sure what the stats are. I know in my experience, I've been to appeal a couple of times, and we've won on appeal and we've lost on appeal. So, but most things are won on appeal generally, because it's just the plan is being awkward, or they're trying to protect their constituents, but and not actually going against the planning policy itself. Anyone else? Awesome. Well, look, guys, thanks very much for your time. I really appreciate it, and thanks for your questions and engaging with it. Hopefully that's been helpful. We really appreciate your time. If you have got any questions, or if you'd like to jump on a call with one of us or both of us or whatever to run by any deals that you've got, then we'll send you a link to jump on to book a call after the meeting. It'll probably come out tomorrow. And if you've got anyone, we'll share a recording of the webinar as well. And if you know anyone that this might be interesting too, then please share it with them. We're just, like I said, trying to help educate people. We just want to stop people from getting into deals that don't make sense more than anything else, and losing their hard-earned money. So there is money to be made, but it's making sure you're doing the right deals. So thanks very much for your time. Really appreciate it, and have a nice evening.
Thanks, Gareth. Thanks, Mark. Great job.
Thanks, guys.
Thanks, guys.
Take
care.
Good night.